Welcome to Finance Talks podcast. Today, we're diving into a topic that affects nearly everyone: how to minimize taxes legally in the United States. Taxes are an inevitable part of life, but understanding how to manage them effectively can make a huge difference in your financial health. For individuals, it can mean more money in your pocket to save or invest. For families, it can mean better financial security. And for business owners, smart tax strategies can free up resources to reinvest in your business. So in this episode, we'll be breaking down practical, actionable steps to legally reduce your tax burden. We'll discuss key concepts like deductions, credits, tax-advantaged accounts, real estate strategies, and more. Whether you're an employee, self-employed, or a business owner, there's something here for everyone. Stick with us, because by the end of this episode, you'll have a clear understanding of how to take control of your taxes while staying fully compliant with the law.
Absolutely, Ryan. Minimizing taxes isn't about avoiding them or bending the rules. It's about making informed decisions within the framework of the law. The U.S. tax code is complex, but it's also filled with opportunities for taxpayers who take the time to understand it or consult with professionals. Today, we'll walk through strategies that help reduce taxes without crossing any legal boundaries. For instance, we'll talk about how individuals can use deductions and credits to lower taxable income. Families will learn how to benefit from education-related credits and child tax benefits. And for business owners, we'll cover how structuring your business or leveraging expense deductions can make a significant impact. We'll also touch on planning tactics, like optimizing retirement contributions, using health savings accounts, and taking advantage of real estate tax benefits. Whether you're filing taxes soon or planning ahead, this guide will help you save more while staying compliant.
Now that we've set the stage, let's start with the basics. Understanding the U.S. tax code. The tax system in the U.S. is structured around a combination of federal, state, and sometimes local taxes. At the federal level, we have a progressive income tax system, meaning the more you earn, the higher percentage you're taxed. The key here is understanding your tax bracket and how marginal tax rates work. For example, if you fall into the 22% tax bracket, that doesn't mean all your income is taxed at 22%. Instead, only the income above the lower threshold of that bracket is taxed at that rate. The rest is taxed at lower rates, depending on the bracket thresholds. This is important when planning your taxes, especially if you're close to moving into a higher bracket. It can help you decide when to defer income or make strategic deductions to stay in a lower bracket. You also need to be aware of state and local taxes, as they can vary widely. Some states, like Texas and Florida, don't have state income tax, while others, like California and New York, have some of the highest rates in the country. This means where you live can significantly impact your overall tax liability.
Exactly, Ryan. And let's not forget that taxes aren't just about income. There are various other types of taxes you might encounter: capital gains tax on investments, property tax if you own real estate, and self-employment tax if you're your own boss. The more you understand these, the better you can plan. One critical concept is the difference between deductions, credits, and exemptions. Deductions reduce your taxable income, which lowers your overall tax liability. For instance, if you earn $80,000 and claim a $10,000 deduction, you're only taxed on $70,000. On the other hand, credits directly reduce the amount of tax you owe. So, a $2,000 tax credit reduces your tax bill by $2,000, which is incredibly powerful. Exemptions used to reduce taxable income as well, but with the changes from the Tax Cuts and Jobs Act, personal exemptions were eliminated, though some benefits were rolled into the standard deduction, which doubled in size. It's also worth noting that staying compliant and up to date with tax laws is crucial because they can change frequently. Knowing these basics lays the groundwork for everything we'll discuss next: maximizing deductions and credits to your advantage.
Now let's talk about deductions. Deductions are one of the most effective ways to lower your taxable income, which in turn reduces the amount of taxes you owe. The first thing to understand is the difference between the standard deduction and itemized deductions. The standard deduction is a flat amount set by the IRS that most taxpayers can claim. $13,850 for single filers in 2023 and $27,700 for married couples filing jointly. It's straightforward and doesn't require you to track expenses. But if your deductible expenses exceed the standard deduction amount, you should consider itemizing. This requires more effort since you'll need documentation, but it can save you significant money if done correctly. Common itemized deductions include mortgage interest, state and local taxes, up to the SALT cap of $10,000, medical expenses exceeding a certain percentage of your income, and charitable contributions. If you're a homeowner or have significant medical expenses, itemizing might be worth it.
Exactly, Ryan. And let's go a bit deeper into some high-value deductions. For example, if you're self-employed or run a small business, you have access to a range of deductions that can make a big difference. You can deduct expenses like office supplies, equipment, business travel, and even a portion of your home if you use it as a dedicated office space. The home office deduction is often overlooked, but it's completely legal as long as you meet the requirements. It must be a space used exclusively for work. Another important deduction is for medical and dental expenses, which can be deducted if they exceed 7.5% of your adjusted gross income. So, if your AGI is $100,000 and you have $8,500 in qualifying medical expenses, you can deduct $1,000. Charitable contributions are also a great way to give back and reduce your taxable income. Whether you donate cash, goods, or even securities, you can claim these as deductions. Just make sure you keep detailed records and receipts for everything you donate. And for those who want to go the extra mile, consider donating appreciated assets like stocks. This not only gives you a deduction, but also avoids capital gains taxes on the appreciation. Deductions might seem complex at first, but if you take the time to understand them, or better yet, work with a professional, you can uncover significant savings.
Moving on to tax credits, these are arguably even more powerful than deductions. Why? Because while deductions lower your taxable income, credits directly reduce the amount of tax you owe dollar for dollar. For example, if you owe $3,000 in taxes and you qualify for a $2,000 credit, your tax bill is reduced to just $1,000. Some of the most well-known credits include the Child Tax Credit, CTC, which offers up to $2,000 per qualifying child under the age of 17. Then there's the Earned Income Tax Credit, EITC, which is designed for low to moderate income individuals and families. Depending on your income and the number of dependents, this credit can provide substantial relief. The great thing about these credits is that many are refundable, meaning you could receive a refund even if your tax liability is reduced to zero.
That's right, Ryan. And let's talk about education-related credits. If you're pursuing higher education or supporting a family member in college, the American Opportunity Tax Credit, AOTC, is incredibly valuable. It offers up to $2,500 per eligible student for qualified education expenses, such as tuition and required course materials. There's also the Lifetime Learning Credit, which provides up to $2,000 per tax return for education expenses. Unlike the AOTC, it's not limited to undergraduate education. It can be used for graduate courses or even skills-improving classes. However, one key point: these credits have income limits, so high earners may not qualify. That's why planning is so important to ensure you're maximizing these opportunities without crossing eligibility thresholds.
Another area to consider is energy efficiency credits. If you've made your home more energy efficient by installing solar panels, energy-efficient windows, or advanced HVAC systems, you could qualify for credits like the Residential Clean Energy Credit. For solar installations, you can currently claim 30% of the cost, which is a significant incentive. There are also credits for purchasing electric vehicles, EVs, like the Clean Vehicle Credit. These credits can range from $4,000 to $7,500, depending on the make, model, and battery size of the vehicle. If you're planning on going green, these incentives can make the transition even more affordable while reducing your tax liability.
Lastly, let's not forget the Child Independent Care Credit, which is perfect for working parents. This credit offsets a portion of the expenses you pay for childcare or even care for a dependent adult, like an elderly parent. Depending on your income, you could claim up to 35% of qualifying expenses. And remember, keeping detailed records for any credits is absolutely essential. If you're audited, you'll need to show proof of eligibility. Credits can be life-changing for your finances, but they require careful planning and attention to detail. With the right approach, these tax credits can significantly reduce what you owe and put more money back in your pocket.
Let's shift focus to retirement contributions, one of the smartest ways to reduce your tax liability while planning for your future. The U.S. tax code provides significant incentives for saving for retirement through tax-advantaged accounts like traditional IRAs and 401ks. When you contribute to these accounts, your taxable income is reduced by the amount of your contribution, up to the annual limit. For example, in 2023, you can contribute up to $22,500 to a 401k if you're under 50, or up to $30,000 if you're 50 or older. This reduces your taxable income immediately. Contributions to a traditional IRA offer similar benefits, but you need to be mindful of income limits for deductibility, especially if you or your spouse are covered by a workplace retirement plan.
That's a great point, Ryan. And let's not forget about the Roth IRA, which works a little differently. With a Roth IRA, you contribute after-tax dollars, so you don't get an immediate tax deduction. However, the real benefit comes later. Your investments grow tax-free, and qualified withdrawals in retirement are also tax-free. This can be a powerful tool if you expect to be in a higher tax bracket in the future. For higher income earners who exceed the contribution limits for a Roth IRA, there's a strategy called the backdoor Roth IRA. This involves contributing to a traditional IRA and then converting it to a Roth IRA. It's completely legal, but you need to be careful about the tax implications, particularly if you already have other pre-tax IRA balances.
Another powerful option is the Health Savings Account, HSA, which is technically a health account but doubles as a stealth retirement account. Contributions are tax-deductible, growth is tax-free, and withdrawals for qualified medical expenses are also tax-free. And here's the kicker. After age 65, you can use HSA funds for non-medical expenses without penalty, although you'll pay regular income tax on those withdrawals, just like a traditional IRA. The contribution limits for HSAs in 2023 are $3,850 for individuals and $7,750 for families, with an additional $1,000 catch-up contribution for those 65 and older 55 or older. If you're enrolled in a high-deductible health plan, this is a must-consider strategy for both current and future tax savings.
And let's not forget employer-sponsored plans, like 401k matching contributions. If your employer offers a match, it's essentially free money that also reduces your taxable income. For example, if your employer matches 50% of your contributions up to 6% of your salary, you're leaving money on the table if you're not contributing at least up to the match limit. For those who are self-employed, options like the Solo 401k or SEP-IRA are great for maximizing contributions. These plans allow for much higher contribution limits compared to traditional IRAs, making them ideal for high-income earners. With these strategies, you're not just saving for retirement, you're also significantly reducing your tax bill in the process.
Let's dive deeper into health savings accounts, or HSAs, which are often overlooked but incredibly powerful when it comes to minimizing taxes. HSAs are unique because they offer a triple tax advantage. Contributions are tax-deductible, the money grows tax-free, and withdrawals for qualified medical expenses are also tax-free. To be eligible, you must be enrolled in a high-deductible health plan, HDHP. The contribution limits for 2023 are $3,850 for individuals and $7,750 for families, with an additional $1,000 catch-up contribution for those aged 55 or older. Unlike flexible spending accounts, FSAs, the funds in an HSA roll over year to year. so there's no use it or lose it policy. This makes it not just a tool for covering current medical expenses, but also a great way to save for healthcare costs in retirement.
Exactly, Ryan. And what's interesting is that an HSA can also act as a secondary retirement account if you don't need the funds for medical expenses right away. Once you turn 65, you can use your HSA for non-medical expenses without a penalty, though you'll pay regular income tax on those withdrawals, just like with a traditional IRA. Another advantage is that many HSA providers allow you to invest your contributions in mutual funds or ETFs, enabling your savings to grow even faster. This makes it a fantastic option for long-term planning. For example, if you max out your contributions every year and invest those funds wisely, your HSA could grow into a substantial nest egg, specifically earmarked for healthcare in retirement.
And let's not forget the immediate benefits of an HSA for people who anticipate significant medical expenses. If you know you'll have high out-of-pocket costs, like surgery or ongoing treatments, you can fund your HSA and pay those expenses tax-free. It's essentially giving yourself a discount on healthcare by avoiding taxes. Another thing to consider is employer contributions. Many employers contribute to their employees' HSAs as part of their benefits package. This is free money that boosts your savings without counting against your contribution limit. Always check if your employer offers this benefit and take full advantage of it if they do.
That's a great point, Ryan. Another useful tip for those approaching retirement is to carefully time HSA withdrawals. If you've accumulated significant savings in your HSA, you can hold off on withdrawing funds until you have large qualified medical expenses. This allows your investments to continue growing tax-free for as long as possible. Lastly, keep in mind that keeping detailed records of your medical expenses is crucial. You don't have to withdraw HSA funds in the same year the expenses occur. As long as you have receipts, you can reimburse yourself years later. Another way to let your money grow tax-free before accessing it. With these strategies, an HSA becomes a powerful tool not only for managing medical costs, but also for long-term tax planning.
Now let's talk about tax strategies specifically for business owners and those with side income. If you're self-employed or own a business, the tax code offers a wealth of opportunities to minimize your tax liability. One of the first things to consider is how you structure your business. For example, setting up as an LLC or electing S-Corp status can provide significant tax benefits. With an S-Corp, for instance, you can pay yourself a reasonable salary and take the rest of your income as distributions, which are typically not subject to self-employment tax. This can save you a substantial amount of money, especially if your income is high. But remember, the IRS has guidelines for what constitutes a reasonable salary, so it's important to strike the right balance.
Exactly, Ryan. And let's not forget the deductions available to business owners. Almost every legitimate expense related to running your business can be deducted. This includes office supplies, equipment, travel expenses, marketing costs, and even a portion of your home if you qualify for the home office deduction. For the home office deduction, you'll need to ensure the space is used exclusively for work, but the savings can be significant. Additionally, consider Section 179, which allows you to deduct the full cost of certain equipment and software in the year it's purchased, rather than depreciating it over several years. This is particularly useful if you're investing in big-ticket items like machinery or technology.
Another powerful strategy for business owners is setting up a solo 401k or a SEP IRA. These retirement accounts allow you to contribute much more than you could with a traditional or Roth IRA, which can significantly lower your taxable income. For a solo 401k, you can contribute both as an employee and an employer, allowing you to save up to $66,000 in 2023 if your income supports it. If you hire employees, offering retirement benefits or health insurance not only helps your team, but can also provide tax deductions for your business. Additionally, consider employing family members, like your children, for legitimate work. This can shift income to lower tax brackets within your household and even allow them to fund their own tax-advantaged accounts.
And for those with side hustles, there are plenty of strategies to reduce taxes as well. Platforms like Etsy, Uber, or freelancing sites often involve significant expenses, such as mileage, internet costs, and materials. All of these can be deducted if properly tracked. Also, consider the Qualified Business Income (QBI) deduction, which allows eligible self-employed individuals and business owners to deduct up to 20% of their qualified business income. It's a substantial benefit for many small businesses, but there are income thresholds and phase-outs, so careful planning is key. Lastly, always keep detailed records and use accounting software to track income and expenses. This not only makes tax time easier, but also ensures you're fully compliant while taking every deduction you're entitled to. With the right approach, running a business or a side hustle can be both profitable and tax efficient.
Let's talk about real estate, one of the most powerful tools for minimizing taxes while building wealth. If you own rental properties, you can take advantage of several deductions and strategies to reduce your taxable income. The most significant one is depreciation. Even though your property might be appreciating in value, the IRS allows you to deduct a portion of the cost of the property each year as a non-cash expense. For residential rental properties, the depreciation period is 27.5 years. So if you bought a property for $275,000, excluding land value, you could deduct $10,000 per year as depreciation. This alone can make a big difference in reducing your taxable rental income. Combined with other deductible expenses like mortgage interest, property taxes, and repairs, you could significantly lower or even eliminate your taxable income from the property.
Exactly, Ryan. And if you're considering selling an investment property, the tax benefits don't stop there. Through a 1031 exchange, you can defer capital gains taxes by reinvesting the proceeds from the sale into another like-kind property. For example, if you sell a property with a $200,000 gain and reinvest that money into another qualifying property, you won't owe taxes on the gain immediately. This allows you to keep growing your real estate portfolio without losing a large chunk of your profits to taxes. It's a powerful strategy, but it does have strict timelines and rules to follow. So it's best to work with a tax professional or real estate advisor to ensure compliance.
Another real estate tax advantage comes from deducting operating expenses for rental properties. These include costs like property management fees, insurance, utilities, and even advertising for tenants. If you actively manage the property yourself, you may also qualify for the real estate professional status, which allows you to offset other income with rental losses. For example, if you meet the IRS's requirements for material participation, you can use rental property losses, such as depreciation and expenses, to offset your regular income, which is a significant benefit for high-income earners. This can make real estate a cornerstone of your overall tax strategy.
And let's not forget short-term rentals, like those listed on Airbnb or Vrbo. These can also qualify for tax benefits, but they follow slightly different rules. If you rent out your property for fewer than 14 days a year, the income is completely tax-free, no matter how much you earn. For those who rent properties for longer periods, the usual deductions apply, including depreciation, repairs, and operating expenses. However, make sure to track everything carefully, especially if you're splitting the property's use between personal and rental purposes. With real estate, meticulous record-keeping is essential to ensure you take full advantage of all available tax benefits.
Let's shift our focus to investments and how they can be leveraged to minimize taxes. One of the most effective strategies is tax loss harvesting. This involves selling investments that have declined in value to offset gains from other investments. For example, if you made a $10,000 profit from selling a stock but lost $5,000 on another, you can use that loss to reduce your taxable gains, lowering your tax liability. Even if your losses exceed your gains, you can use up to $3,000 of those losses to offset your ordinary income each year. Any remaining losses can be carried forward to future years. This strategy is particularly useful for investors who actively manage their portfolios and want to reduce the impact of taxes on their returns.
That's a great point, Ryan. And another key strategy is holding investments for the long term to benefit from lower long-term capital gains rates. If you hold an investment for more than a year before selling, your gains are taxed at preferential rates, 0%, 15%, or 20%, depending on your income. In contrast, short-term gains from assets held for less than a year are taxed at your ordinary income rate, which can be significantly higher. For those in higher income brackets, it's especially important to plan the timing of your asset sales to avoid bumping into higher tax rates. Spreading out gains over multiple years or strategically selling in lower income years can help minimize the overall tax impact.
Another valuable tool for minimizing investment-related taxes is tax-advantaged accounts. Contributing to accounts like traditional IRAs, 401ks, or Roth IRAs allows your investments to grow tax-free or tax-deferred. For example, if you invest in a traditional IRA, you won't pay taxes on gains until you withdraw the money in retirement when you may be in a lower tax bracket. Additionally, consider tax-efficient mutual funds or ETFs for your taxable accounts. These funds are designed to minimize taxable distributions by keeping turnover low and managing capital gains distributions carefully. This is a great way to reduce the annual tax hit from your investments.
And for those looking for even more advanced strategies, consider qualified opportunity zones. By investing in these designated areas, you can defer capital gains taxes from other investments and, in some cases, even reduce them after holding the new investment for a specified period. Additionally, don't overlook municipal bonds. The interest income from these bonds is typically exempt from federal income tax, and in some cases, state and local taxes as well. This makes them an excellent choice for high-income earners looking for tax-efficient income. The key takeaway here is that smart investment planning not only grows your wealth, but also significantly reduces your tax liability over time.
Tax planning isn't just something you do at the end of the year, it's an ongoing process. One of the most effective strategies is timing your income and expenses to manage your tax bracket. For instance, if you anticipate earning significantly more in a given year, you might look for ways to defer income into the next year to avoid being pushed into a higher tax bracket. Similarly, accelerating deductible expenses such as property taxes or charitable contributions into the current year can help reduce your taxable income. For business owners, timing is even more critical. You can defer billing clients until the next year or make early purchases for equipment or supplies to maximize deductions in the current tax year. These small moves can have a big impact on your overall tax liability.
Exactly, Ryan. And another essential strategy is making quarterly estimated tax payments if you're self-employed or earning significant non-wage income. The IRS requires taxpayers to pay taxes as they earn income throughout the year, and failing to make these payments can result in penalties. By calculating and paying estimated taxes on time, you can avoid surprises and ensure you're staying compliant. Another tip for year-round planning is keeping track of life events that might affect your taxes. Events like getting married, having a child, buying a home, or starting a business all come with tax implications. For example, having a child could make you eligible for additional credits, while getting married might change your filing status and affect your tax bracket. Staying proactive ensures you're taking advantage of every benefit available to you.
Another key area of focus is tax loss harvesting throughout the year, not just at year end. If you notice your portfolio has underperforming investments, you can sell them to realize losses and offset gains. This strategy isn't just limited to December. Doing it periodically helps you manage your tax liability more effectively. And for those with variable income, such as freelancers or commission-based earners, staying ahead of your tax situation is critical. Using tools like tax projection calculators or working with a CPA can help you adjust your withholding or estimated payments as your income fluctuates. This proactive approach minimizes surprises and ensures you don't overpay or underpay throughout the year.
And let's not forget the importance of contributing to tax-advantaged accounts early in the year. Whether it's a 401k, IRA, or HSA, the earlier you contribute, the more time your money has to grow tax-free or tax-deferred. For example, if you max out your IRA contribution at the beginning of the year instead of waiting until April of the following year, you gain an extra year of tax-free growth. Lastly, if you're close to retirement, consider strategies like Roth conversions in low-income years. By converting some of your traditional IRA funds into a Roth IRA during a year when your income is lower, you can pay taxes at a lower rate now and enjoy tax-free withdrawals in retirement. This kind of forward-thinking planning can make a significant difference in your long-term tax picture.
Let's wrap up our discussion by talking about the value of seeking professional tax assistance. Navigating the U.S. tax code can be overwhelming, especially with its frequent changes and complexities. Hiring a certified public accountant, CPA, or a tax advisor can save you both time and money by ensuring you're taking full advantage of available deductions, credits, and strategies tailored to your specific financial situation. For example, a CPA can help you plan for major life events, like selling a business, buying a home, or retiring, to minimize the tax impact. They can also assist with proactive strategies like year-round tax planning, retirement account optimization, and navigating complex tax scenarios such as multi-state income or foreign investments. Their expertise can uncover opportunities you might not be aware of and ensure you remain fully compliant with the law.
Absolutely, Ryan. And beyond CPAs, for those with more complex situations, such as high net worth individuals or business owners, working with a tax attorney or an enrolled agent can provide even greater value. A tax attorney specializes in legal strategies, estate planning, and even resolving disputes with the IRS, while an enrolled agent can represent you in audits or negotiations. For business owners, having a professional who understands business tax laws is invaluable. They can help you structure your business for maximum tax efficiency, ensure your bookkeeping is accurate, and provide guidance on long-term planning strategies like succession planning or tax-advantaged investments. Their insights often pay for themselves through the savings they uncover.
Another benefit of working with professionals is staying updated with the latest tax law changes. For example, the Tax Cuts and Jobs Act brought significant changes a few years ago, and many taxpayers missed out on opportunities simply because they weren't aware of the updates. Professionals make it their job to stay informed and ensure you're applying the newest rules to your advantage. And if you ever face an IRS audit or receive a notice, having a CPA or enrolled agent in your corner can make all the difference. They can handle communication with the IRS, represent you in disputes, and provide the documentation needed to resolve issues efficiently. This peace of mind is worth every penny, especially when dealing with complex tax matters. That's such an important point, Ryan. And one more thing, don't wait until tax season to seek help. Working with a tax professional throughout the year allows you to implement strategies proactively, rather than scrambling to find deductions and credits at the last minute. For instance, they can help you adjust your withholdings or estimated payments, identify retirement contributions to make before year end, and even advise on charitable giving strategies that maximize your impact and tax benefits. Lastly, remember that tax planning is not a one-size-fits-all approach. A professional can customize strategies based on your specific goals, income level, and financial situation. Whether for retirement, business, or estate planning, their expertise helps you optimize opportunities while staying compliant for benefits now and later.